Hello, this is Susan Hayes, the Positive Economist, and today I'm going to go through another of the videos in the series investinginyouth.com, introducing Wall Street to the classroom. Today I'm going to look at how to value stocks with a particular reference to the dividend yield. Firstly, what is a dividend? Well, it's a payment from the company that you bought its shares on the stock market to the shareholder, which is you if you purchased those shares, for holding the stock. It's an incentive to buy the stock. So why do companies give you money for that? Well, if you had the choice to buy one stock from two that bore the same risk, which would you choose? A company who paid you a sum every 3 months to hold a stock, or a company who doesn't pay you to hold a stock at all? Well, the first one, of course. So why do companies issue dividends? To give you an incentive to buy the stock of the company. You must note as well that there are many pension funds and various other different types of funds that buy stocks simply because they offer a decent dividend relative to their price. And because companies can offer high dividends, that is an incentive for those funds to buy their shares also. Remember these? The River Island dress, the red Ferrari, and the piece of steak? Well, I did mention in the past video how these would come back to light again. Well, how did we know each of those items were on sale? Was because we were buying the same car, dress and steak, but just at a lower price. So what has that got to do with the dividend? Well, it's all about buying good value. By buying a stock, you are also paying to get a dividend. You are paying to get paid. So why not buy it when it's on sale, when you can get paid more for paying less? And how do you do that? Well, let's look at this. The company decides that they will issue, for example, 20 cents a share. If you buy the share at €1, €3 or €5, you will still get the same dividend. Similarly, if you paid $1 million this month or $900,000 next month, you would still get the same Ferrari. You are buying the same thing, but just at a lower price. Now, the dividend yield is a measure of this. So how can you judge if a stock is on sale by looking at its dividend? Well, the dividend yield is equal to the dividend per share divided by the share price. Now, I have the dividend per share in red here because ordinarily the dividend per share doesn't change. It is decided at the company's AGM or EGM or at whatever meeting that the company decides on their dividend, but it's fixed from that point onwards. So that dividend might be fixed 3 months in advance of actually issuing it. One way or the other, it doesn't change every second of every trading day like the share price does. So let's consider the dividend per share fixed, but as the share price goes down, well then the dividend yield goes up. So as the share price goes down, the dividend yield goes up. Since the dividend per share is fixed, the higher the dividend yield, the better the sale, the better the value. And that is the way it simply works. So consider what I had in red, the dividend per share fixed, and as the share price goes down, the dividend yield goes up, and therefore the better the value on offer. So again, we'll take that company that pays 20 cents per share as a dividend. So calculate the dividend yield for investor A and B. Well, investor A buys the stock at €2.50 and investor B buys the stock at €5. In the case of investor A, 20 cents divided by €2.50 is a dividend yield of 8%. However, 20 cents divided by €5 is a dividend yield of just 4%. And bear in mind, no matter what price you buy the stock at, you're going to get the same dividend. Every shareholder gets the same dividend regardless of the price of the share that they bought it at. So which yield would you prefer? Well, if you have enough money to buy just 2 stocks in the following table, which would they be? Now, it's very hard to just simply pick out a stock out of the list here. And bear in mind, I did refer to sector before. Vodafone, O2, Meteor, 3 and China Mobile. They all operate in the same sector. They may operate in slightly different geographical areas, and also they may trade in different markets. In addition, as you can see, they have different share prices. But how can you then compare between them all, since everything is different? Well, if you look over here to the dividend yield column and the question marks, that's really what you need to find out. Now, in order to fill up this table, you simply divide 0.14 divided by 150 in the case of Vodafone. You do 0.4 divided by 6 in the case of O2, and so on the whole way down. Now, if you'd like to work them out at this point, pause the video, as I will be moving on to the next slide at this stage where all the answers are filled in. So, if you have €5,000, how many shares of each stock would you buy? And bear in mind, each transaction cost would be about €50. So we'll take €5,000 divided by 2 is €2,500. And 2,500 divided by the price of the stock is the quantity of shares that you will actually buy. So how much dividend would you receive this year? All you need to do here is the quantity of shares multiplied by the dividend per shares, but the dividend per share for both shares, and add them up. So let's do this. Okay, first of all, Vodafone is offering a dividend yield of 9.33%, O2 is offering a dividend yield of 6.67%, Meteor is offering a dividend yield of 7.714%, 3 is offering a dividend yield of 8 cent divided by 367, which is 2.17%, and China Mobile is offering a huge dividend yield at 10.625%. Now, bear in mind, please do note that none of these figures are actually true. These are ones that I picked arbitrarily myself for the purposes of this exercise. So clearly, if you had enough money to buy just 2 stocks, you would pick the 2 with the highest dividend yield, of course. So at this point, we have €5,000 net of transaction costs. So we take €5,000, take away the transaction costs, we have 4,900. Divide that by 2, so we have 2,450 as our net amount to pay. In the case of China Mobile, the cost of the company is $3.20 per share, and in Vodafone it's $1.50 per share. So then if we do the respective calculations, we see that you can buy 765 stocks with China Mobile and 1,633 stocks with Vodafone. So how much dividend would you receive this year? Well, you would get 765 shares at 34 cent each of a dividend, which is €260, and in Vodafone you would get 1,666 shares multiplied by 14 cent per dividend to equal 228.62. So the total amount here is €488.72. So the return from dividends alone is almost 10%. And how you always compare what the level of value you're being offered in the stock market compared to other non-risk assets is compare your dividend yield on your entire portfolio to the rate at the bank. So a dividend yield strategy would be to pick 10 stocks which offer the highest dividend yield, hold them for a year and sell them next year if they're still not offering the best dividend. Now you choose a year so as to give companies time to develop. Remember, in the speculating versus investing video, too much chopping and changing incurs many transaction costs and doesn't allow the stocks to grow. So the features of a successful strategy: remember, we did this in a previous video, know what to buy. In this case, you know exactly what to buy. You want to buy stocks with the highest dividend yield. Know why you're buying it. Well, again, they are offering the best dividend at the lowest prices. Know when you will sell. Well, you will sell in a year if they're not offering the best dividend yield at that point. Buy a number of stocks. In this case, we refer to 10 stocks to make sure that you have optimum diversification. And time tested. This particular strategy has been tested by many financial analysts. And that is why, as I mentioned, those pension funds and other types of funds choose stocks with a high dividend yield because they know that this particular system works. So now, do it in real life. And how you can do that is maybe get a page of the Financial Times with all the dividend yields on it. Alternatively, you can go onto other types of websites or different types of trading platforms, or else you can go to the actual company's annual accounts and look at the dividend that is being offered next year relative to the trading price at the moment.